Good morning, Jags. This is Fahad and Chronicle here, bringing you a new thematic idea in Jaguar Media. The symbol is ACA. The name of the company is called Arcosa. Hi, Chronicle. How are you doing?
Morning, Fahad. Glad to be here as always. This will be our first production of the year.
Yep, this is our first production of this year. So I do want to set the grounds over here a little bit. So this will fall into the same category of Buy America and Build America theme stocks that have tremendously benefited Jag clients in the past several months. So, for example, companies like Flower, FLR, or Jacobs Engineering, J, which was a top pick in the fourth quarter outlook, or Construction Partners, symbol ROAD. Alcoa, Tech Resources, all of those names. So this will fall in the same infrastructure category, Buy America, Build America theme. So let's get started. This is a very interesting company given the exposure that the company has to high growth markets, particularly in the clean energy business, the wind turbines and such. So with that said, what is the first thing that stands out for you as you want to present this bullish case?
Sure. So, just very quickly, the theme here is we're getting more selective on infrastructure. Like, if you go back and look at our past archives, whether it's Jaguar Analytics or Jaguar Media, you'll know that we've been extremely bullish on infrastructure for the past couple of quarters. But now I think it's time to start being more careful about what kind of infrastructure stocks we want to own as we get closer to Biden's first 100 days, because I think that's when we'll start to see some diverging performances within the sector. Like, not every company is going to benefit equally from Biden's eventual policies. So essentially, what we're trying to do here is, rather than abandoning the Buy America and Build America theme, I think it's best to be spreading our eggs in multiple infrastructure baskets, so to speak, rather than being long companies that are too specialized in one area. So moving on to the next slide, I'm bringing this company called Arcosa. This is a pretty recent spinoff from Trinity Industries, which happened back on May 2019. And when they split with Trinity, they took with them the energy equipment, transportation, and construction products business. And those are what make up the three segments of the company today. Recently, they've been making a lot of acquisitions within construction, with their huge cash pile from all the synergies and all the operational efficiency projects that they've done. But on the whole, they're pretty diversified.
Interesting. The energy equipment segment, which is 48% of revenues, that goes after the wind and the conventional energy, is the one that is my most important focus on this stock. But going back a bit to the point about what Biden may do in the first 100 days in the office, while it's anyone's guess, but I think directionally everybody can agree that they certainly want to do more infrastructure projects, and they're going to include into that a heavier emphasis on green energy, right? And so, just a quick background over here to those who do not know. There was a way back, if you go back to 2009 when Obama won the elections, there was a major bill that was passed then too called American Clean Energy and Security Act of 2009, which was part of the infrastructure package at that time after Obama won the office. And then in 2015, there was another bill passed by Congress, all the Democrats essentially, which called for a 30% increase in renewable energy goal by 2025. And then more recently, in March to June period of this year, there was another major push into increasing the renewable energy tax credits. Much of it was basically put off until the election, and I think those are the kind of bills that can come forward rather very, very quickly once Biden takes the office during his first 100 days in the office. Now, staying on that path, there's one more thing that we need to keep in mind, because the timing of this presentation is very interesting, because today we have Georgia runoff elections, and so results will be known by tomorrow. What this means is if the Senate does go in the hands of the Democrats, then we know that some of these clean energy policies can get a much easier push through the Senate than they faced previously. So some of this politics is important because it will drive some of these stocks. Now, with that said, let's move on to the energy equipment segment for Arcosa, the wind towers. Tell me about it.
Sure. Now, because it's energy, you might be tempted to think that revenues are highly volatile and cyclical for this segment, but believe it or not, this segment actually generates the most stable revenues. There are three subsidiaries here. The first one is Arcosa Wind, which happens to be one of the largest manufacturers of wind energy towers across North America. Domestically, I'd say that the competition within this space is not as intense as what it's like internationally, where the biggest competitor globally is from Spain. General Electric is their largest customer here, representing just under 1/5 of revenue. Like they've been competing with mostly foreign companies, as I've said, but if we're going to have Buy America, Build America policies, then this might see some benefit versus buying foreign. But more importantly, this subsidiary has also been a major beneficiary of production tax credit hikes and incentives. If we remember, recently on December 21st, Congress passed a $35 billion spending bill on clean energy as part of the $1.4 trillion extension package, along with the $600 checks. That's going to include a 1-year extension of those production tax credits for wind projects, and also an extension of offshore wind tax credits through 2025, and that's at 30%. So this is a tailwind going into next year. Now, the other major subsidiary here is Mayer Utility Structures, which manufactures and installs electricity transmission infrastructure. That includes transmission towers and substations. Naturally, this is a very stable business, even during recessions, because it's utilities, and their customers here are established energy providers, and they're mostly on long-term contracts. But keep in mind, just because I said it's stable doesn't mean that there's no growth. First of all, Arcosa CEO Antonio Carrillo said that the company is currently seeing demand outpacing production capacity. And then secondly, the company recently did some acquisitions totaling $340 million here. Specifically, they acquired East Point Industries and a couple of concrete pole plants. And Fahad, this essentially paves the way for expansion into telecommunication, lighting, and concrete transmission structures, which are all expected to benefit from 5G.
This is an interesting piece over here because there's one thing that's important to remind everybody here. This company, despite the pandemic, in the first quarter of 2020, the revenues grew by, for this energy equipment segment, it grew by 7% year over year, and then 9% growth in the second quarter despite shutdowns, and then 7% growth in the third quarter. And this was all before this company received this $35 billion spending bill on the clean energy R&D, which included the extension of the tax credits for wind projects through 2025. And so those should naturally be kicker going into 2021 that could potentially accelerate that. Any more bills that will come from a Democratic-led House, Senate, presidency, whatever, is also going to simply expedite those kind of movements. And then the utility structures that you're talking about with an entry into the 5G build out theme and telecommunication, that's another kicker on top of all this that has yet to come into the picture to further support or accelerate top line revenue growth. So there are all these drivers of growth, and that could potentially materialize in significant way in 2021 and beyond. And before they even come into the picture, this company was already growing at high single-digit percentage top line revenue growth in the energy equipment segment. Moving on to the next one, the transportation segment. This is where the company has exposure to rail cars and such. Tell me about this one.
Sure. So, to be frank, this segment is still slow to recover. I'm specifically talking about Arcosa Marine subsidiary here, which makes a variety of transportation barges. During Q3, the company reported they only received $18 million of new orders, and their backlogs declined to $178 million from $259 million in Q2. Not good. And looking at management commentary, it looks like What's holding it back is weak demand for oil and petrochemicals, because the entire industry right now is too afraid to commit capex. So until that improves, which I expect it will, this will continue to see headwinds. But on the flip side, the company is now seeing significantly improved fundamentals within dry bulk and deck barges because of agriculture and high demand from China. Like if you look at the recent news, there's a massive shortage of containers and aquatic transportation hardware right now, especially in Asia Pacific. Arcosa is seeing some benefit from that. So overall, I stated in the write-up that this barge and container securement business is a mixed picture right now. But management did say that orders have begun to improve significantly since the end of Q3. Now, the other subsidiary is Arcosa Transportation Components. Basically, this business makes all sorts of hardware solutions for railways and trucking, and also some mining equipment. Majority of sales here are from rail and things like coupling, axles, and circular forgings. Looking ahead, I think this is going to see benefit because if we look at this slide, we have the latest checks from Stifel from December 29th, which show that year-over-year rail volume comparisons on a weekly basis are already much better than they were in Q1, even before the pandemic began. And we're also coming up to much easier comparisons in Q1 and Q2.
Yeah, and that's a very important point. Optically, I think Q1 and Q2 is going to shine because the comparisons are just so easy for some of these cyclicals that were shut down. To the point about transportation, the little bit exposure that the company has to the oil and gas industry, which is dependent on the capex cycle coming back before they see an uptick there. We're going to see that, aren't we? Because, I mean, you see the crude oil is ripping higher today, up 4%, now nearing $50 per barrel, WTI, Texas, that is. And we have the manufacturing PMI that came out this morning rising to a level of 60, which was incredible that how quickly we have come out from this pandemic. And now we're at 60 expansion phase on the ISM manufacturing PMI for the month of December. And the comps, year-over-year comps, will still stay very easy for the next 6 months. I personally think that the oil industry will make a comeback with its capex rising in the next couple of months. Would you agree?
I completely agree. And if you, this was related to one of our top picks in the current Q1 outlook as well.
Yep, absolutely. Very strong rally shaping up in the energy sector today. Moving on to the last segment that the company has, which is the construction product segment. Any kind of very focused, specific infrastructure projects that will be passed by Biden in the first 100 days in the office, this is the segment where I would think they would benefit the most. So tell me about it.
Sure. So first off, there are three things that they do here. First off, they operate reserves in almost a dozen different locations, which contain sand, gravel, and limestone, all of which are used in construction. In terms of geography, this is mostly in Texas, where and they are the largest sand and gravel operator there. Second thing within the segment is that they are the largest producer of shale from rotating kilns, as well as clay lightweight aggregate in all of North America. So again, these materials are typically used for road and bridge repairs and construction, and also the production of concrete and all sorts of public infrastructure. And then lastly, the company also makes what we call trench shoring and shielding equipment. Basically, if you look at the bottom right picture, these are support structures that help to prevent cave-ins and landslides below the ground level. Now, obviously, this segment has been a massive beneficiary of infrastructure tailwinds. Sales have stayed robust throughout last year, increasing 41% year over year in Q1, 28% in Q2, and then up 27% in Q3. And for Q4 and beyond, management continues to see high growth within Texas, and they are happy to see the one-year extension of the FAST Act. And in their own words, management said that they are very positive about growing this segment in 2021 at a very healthy level. This is why they've done a lot of acquisitions in this space recently, totaling roughly $735 million. So they are betting big here on Buy America, Build America, because this is the segment which will presumably generate the highest cash flow during good times because of their high margins. So
Yeah, I just want to read a quote directly, and sometimes, sometimes the most important thing is that just a line or two that comes directly from the CEO is becomes the most important case around it's the stock. And so this is the most important in your write-up, which will be published with this presentation along with the slide deck on Jaguar Media. People, all the audience get downloaded from there. But here's a quote from the CEO. The majority of the aggregates business is located in high growth geographies, particularly Texas, where construction activity has remained robust. We will have strata acquisition for the full year. We will have all these small acquisitions that we did for the full year, and we have organic growth. We have invested in the Houston area, as Scott mentioned. We are investing around the Dallas Fort Worth area. We're investing around some of their operations, and the shoring business is looking better. I think the construction segment, if you put all of those things together, we are very positive about growing it in 2021 at a very healthy level. Unquote. And I think that's the most important point. That's all one needs to hear, because this is the piece that grew by um, that the construction segment piece by double digits, between 20 and 40% year over year in each of the last 3 quarters. And I think that trend will continue well into 2021. On the secondary bull case, tell me about this one, about free cash flow.
sure. So this is equally as important, I think, and it's to do with the company's free cash flow generation having improved significantly following their spin-off from Trinity. So we can see from this graph on the right that free cash flow shot up roughly 500% in 2019 and has continued to improve through the latest reported quarter. Now, according to management, the reason for this is because following the spinoff, they did a lot of internal and operational restructuring, which resulted in a significant decrease in working capital and operating expenses going forward. And in the latest conference call, both the CEO and CFO said that they continue to make progress in making their accounts payable more efficient. And they said that they have more room to go. And then inventory remains the biggest opportunity for further reduction of expenses. This is great because right now the company only has about $250 million of debt and 0.13 debt to equity, and they are planning to use their cash to make even more acquisitions for the energy and construction segments.
On a free cash flow yield basis, based on the trailing 12 months period, which is naturally a lower bar, and that's only going to go up from here. This stock is trading at 8.5 times free cash flow yield, which is quite attractive. But I would imagine with the improvements such as inventory realigning and all of these growth drivers and construction projects coming into picture, that free cash flow is only going to further skyrocket it into 2021, making this yield possibly go up to 10% or maybe 12% free cash flow yield. That makes it a very, very attractive name. Maybe even becomes an acquisition target. This is only a $2.6 billion company. So, and then the last slide that you have here is the commentary from the Midwest Industrial Summit, which is a conference that recently took place on December 15th. What did you see there?
So a couple things caught my attention. The first one, they did mention that the 10-year, $75 billion construction budget in Texas. That's one thing to watch. The other thing is within the energy segment, there's a bit of a tailwind from successful anti-dumping cases against India, Malaysia, and Spain. There's also an ongoing probe into Chinese wind towers, and if we get a favorable ruling for that, then it could also benefit Arcosa. And then finally, for transportation, shipment levels for dry and bulk remain favorable because, as we said, agriculture is going strong. There's also a shortage of supply within Asia Pacific, led by China. And it's important to note that only roughly 175 barges have been produced annually over the last 4 years, and the replacement level should be closer to 500 units. So there should be an acceleration of orders down the road.
Fantastic. So all these others catalysts identified on December 15 could be in play as well going forward from here. Lots and lots of information to absorb over here, folks. Thank you very much for watching. I hope this was constructive. You learn a lot about this company. We believe it's a great play to play the Buy America, Build America theme, which is a theme that will continue for many more quarters to come. So great stuff. Chronicle, thank you for doing this. Fantastic presentation. Jags, just a reminder, this presentation will be available in Jaguar Media later today, including with the full write-up as well as the slide deck, the research note, everything on Jaguar Media. Feel free to download from there. And we are looking for significant upside in this stock over several quarters and years to come. That's it from us. We'll see you in the chat room shortly.